Be due in 60 days, which is March. I'm looking at my handy dandy cash budget. In March, do I have an additional $6,000? Yes, I do. However, I have been a good accountant, and I have actually projected the whole year. And what I do know is by May, remember, I've already reduced that by $2,000 because I paid back my principal line of credit. So now in May, I only have $37.22. I do not have. Remember, that's the cash balance. If I now spend $6,000 in March on my new sign, by May, I will be in the negatives. Correct? Yes. Okay. So can I cash flow it? I can in 1 month, but that's why I've done a cash budget. Because by 2 months down the road, I needed that $6,000 to support my internal operations and the growth. What could I do? Let's say I have to have this sign. What are some other ways that I could cash flow it? You bet. I could finance it, which would do what? Reduce my cost? Absolutely. Could I, maybe I could lease it, right? Which also, again, would reduce my cost. So other options, I could delay, delay it until I knew a little better about how the year was going. But that's why I did a cash budget. Okay, one last one. And I laugh because the owner was actually doing this. And we used to joke and say he had a girlfriend in Joplin, but really he was pulling money out of the business to pay for the child's tuition costs, and it was expensive. I thought maybe the child needed a JOB, but that was just my opinion, it's expensive. So again, he's pulling money out, so this is a draw. Remember, this is an LLC being taxed like a corporation, so he is an employee. Can he draw $2,000? When does he need it? August. Okay, by August, I've paid the bank $2,000 in March. So in August, now I have $49.96 technically. So can he do it? Yeah, he can. He can cash flow it based upon our cash budget. Again, he might consider a JOB, right, for $2,000. But he can cash flow it. Okay. Last concept. So this really, the cash budget kind of walks you through cash flow and what's your cash flow going to look like and how it affects you, and using historical information to determine that. I'm going to teach you one more really tool, I'm going to call it formula, tool, analysis to use to determine, to help you with cash management. And that's what we call break-even analysis. Probably one of my favorite things. Can be very eye-opening, especially to new businesses started. So just understanding, what's your minimum sales that you have to achieve to break even? Where does it have to be, even on an annual basis, a monthly basis? We're going to do it today on a monthly basis. So what's our break-even point on a monthly basis? And you could do it by any month. I mean, you could take, if your expenses were different monthly, and they are in this particular case, and that's why we're going to use January. Although it's not going to vary a whole lot because we're going to use variable expenses, I'll show you. But we're going to determine a break-even using that information. So first of all, what does break-even mean? It means no profit, no loss. I mean, we break even. And what we're talking about is break even from a cash flow standpoint. It's actually a very simple formula. You all have done all the work already for this business to help them determine what their break-even point is. Because you only need to know two things. you need to know fixed expenses by dollar amount. So you have to estimate all your fixed expenses by dollar amount. Now, you can use fixed expenses by dollar amount by month, and then your answer in forecast would be your sales number by month. You would need to break even. Or you could estimate your fixed expenses annually, same formula, and figure what your break-even point is for the year. So the fixed expenses number is going to determine the time frame, is what I'm telling you. If you use monthly, then that's your monthly break-even. If you use annual, that's your annual break-even. So if you have some seasonality in some of your fixed, we say they're fixed and they don't vary by month, but the reality sometimes we have fixed expenses that vary seasonably. I'm trying to think of some folks that do. If you have a lot of seasonality, you may lay, like Branson, they lay everybody off in those months. That's why their unemployment down there is so difficult, because they technically draw unemployment for like 3 months.
I found it interesting that the state of Missouri on their parks pays a percentage on some months and a flat rate on other months. I've never
Interesting.
seen that before. But Missouri, like, they have certain...
You mean pays for?
Like when they have contracts.
Yeah.
So like if a private business works
Yeah.
with the state of Missouri,
Yeah.
like they specifically say we pay you a flat rate on these 6 months.
Wow.
Or actually, yeah. And then, well, it was actually 4 months that they get a flat rate.
Okay, and what's the months they get a flat rate? I'm just curious.
I don't remember. I mean,
Is it like the low months?
Yeah.
Yeah.
It's low
Okay,
months
that's
that-
what I would
because
expect.
some parks
They're
are
going
closed.
to set a minimum
Yeah.
of what they're going to pay you to support your ongoing fixed expenses.
Yeah,
Yeah.
because not all, but some of them will close down for a couple months. If the tourism is so low, they'll just shut the park down.
Mm-hmm.
But the vendors still get a flat rate. But then the other months, they only make a percentage of revenues. So that they're never going to.
Interesting.
But I just thought that was very bizarre because of that.
It is kind of, it is. So, fixed expenses by dollar amount, variable expenses by percentage. So you can see what I've done. We've added them all up. So our total monthly fixed expenses, we're using January, although I don't think any of ours vary, per se. And then, so we have $11,482 in variable expenses. We have 78%, which is quite a few. So what does that mean? Let's talk that through a little bit. Variable expense, 78%. And what am I saying? What I'm really trying to say about this particular company is, out of every dollar that comes in as a revenue, 78 cents is gone. Every time. Varies in direct proportion to sales, historically. So I only have 22 cents, or 22%, to do what? Cover the fixed. Look at our formula. So on top, we're going to have the fixed expenses in dollars, and on the bottom, we're going to take 100% minus the total variable expenses in percentage. So let's do it. So here we go. So we have $11,482. We're going to divide up the bottom. So we have a 22%, and I would call that a 22% contribution margin. In other words, out of every dollar, I get 22 cents to go to cover all that, 11,482, which means my break even in revenue is $52,191. Let's do the math. That's what I need every month to break even. I probably don't go backwards, but here's what I would do. I like to prove that this is true, in other words. So if I have $52,000 in sales, I said that 78 cents of it is gone every month. If I multiply 52,000 by 0.78, converting that to a decimal, let's see what I get. Fifty-two 191 times 0.78 gives me 40,709. Gone. Subtracting that, 11 is 2, 8, 11, 4 is 1 and 1. Starting to look familiar. My fixed expenses are what? What happened? I broke even. So this is a fun little tool that not only does it give you, I've got to do this to break even, whether it's this month or this year, based upon my assumptions. It also is cool because you can use it to make decision points. For instance, you could use it to determine how much of an increase in sales would I need to cover a new fixed expense. That's always kind of mind-boggling and easy to figure. I would take the new fixed expense amount, again, divide it by our formula, and it's going to tell me how much additional revenue it would take for me to generate enough cash to be able to afford that fixed expense. Let's do it. Can you add another employee? That's usually the first one, right? We want someone specific to do a project. We want someone to answer the phone. We want someone to do the delivery. We want someone to take the load off. Can we afford it? I do this all the time in my other role. Can we afford to hire another employee that will work, do the sales component or do some of those things? Can be very difficult. Can I add another employee? Let's make some assumptions. First of all, my assistant manager I want to hire, it's going to cost me $3,000 a month. Don't forget to include payroll taxes in that. I'm going to assume that I've done that. So this is the full cost. If there's benefits, don't forget to, fill in the benefits. So calculate the sales. So how much will it take? And then is it feasible based upon your deal? I guess I'm going to have to do it. I guess I don't have it in here. Oh, yes, I do. Yes, I do. I thought surely I had that. Okay. So there's my new fixed expense. That's a monthly fixed expense. $3,000 is what I'm going to pay them. I could do the same formula if I wanted a piece of equipment and that was the payment, or doesn't matter, same deal. I'm going to divide it by the 22%. Whoops, sorry. So every month, I've got to sell $13,636 more dollars to pay that salary. It isn't near as exciting when I do the math, right? Now, if that takes away, frees somebody else up to do some additional revenue side, yay. But if it doesn't, if what you're doing doesn't free anyone up to increase sales, you're going to have to figure out a different way to pay for it, right? You would have to have the additional cash flow already there to be able to support the new expense. Okay. Let's wrap it up. Okay, so here's what we've done today. We started by focusing on forecasting and how important that sales forecast is in cash budgeting. In fact, it's so important that it's where we start everything in a budgeting process. And that's why your vendors spend thousands of dollars on forecasting it. And we spend lots of time on trying to figure out what that sales forecast may be. Then we use that information and the historical information, the analysis that we've worked on for the last 2 weeks really, to make some assumptions to use in our actual cash budget. We created our own At least we did 3 months today of creating our own cash budget. Then, it's always good. We used it, yay, right? Not only did we discover that we had a hiccup in January, we have a negative cash flow that's pretty significant, enough to throw us into a negative bank position. We also figured out we can't buy a sign, at least not the way we determined. We can't support it through cash flow. So we used it to make some informed decisions. So here's what I hope we accomplished. Cash budgeting is really all about learning and understanding what you can afford and what you can't to make you feel better about your assumptions and your decisions as they relate to future growth. Loans. Do you need more money? Can you take some more money out? And, can you make that additional purchase, whether it be in terms of a new employee or a new capital item? Okay, some things to think about. This is our Focus on Financial Management series. I hope you've enjoyed it. I've enjoyed. This is my 3rd week. I feel like I don't know what I'm going to do next Wednesday, right? I won't be coming to West Plains. It's terrible. Anyway, thank you all. I appreciate it.
It was very good, thanks.
Thank you.
It took the scariness out of some more paperwork for me.
Yeah, I understand